All right, team. Here we are. We are going to cover. This is Professor Rod Dog, Professor Rodney Carter. We are going to cover the debit and credit framework. Whoa, mic problems. We're going to cover the debit credit framework. We're going to go over what a normal balance is. We're going to talk about what increases and decreases the types of accounts in our financial accounting world. We are going to briefly talk about the why. Why do we do this? Why do we have this alien language that we have to deal with? And we will then move on to journal entry, T accounts, the general journal, and the general ledger. The general journal has journal entries in it. The general ledger is a record of accounts, the specific account, cash. We're going to look at what comes in and out of cash on a series of transactions. I have got some good journal entries to work through, and then finally we will take somewhat of a trial balance here. This is just a listing of accounts. A trial balance would have an order to it. This is kind of scattered on purpose to make you identify account types. So without further ado, let's get started. When we have accounting transactions, we are trying to accurately record the transaction so that we can build good financial statements. If we don't have good financial transactions and journal entries, then we won't be able to produce quality, consistent, accurate GAAP, generally accepted accounting principles, US GAAP, United States GAAP financial statements. So if I can make a plug here on the why. The why is that we need good accounting at the transaction level, meaning each financial transaction in a business is its own separate transaction. And if we accurately record all of those, then we can help compile those transactions and make financial statements. We can use financial statements to make internal decisions. We can use the financial statements. We must give them to some external users like the IRS, the state auditors could ask for them. We need to possibly give them to banks, to shareholders or owners, equity owners in a business, even if it's a small business. So here we go. This asks us what increases the following accounts. So we are trying to figure out what increases an account and what decreases an account. So if I could add something here, I'd maybe add in a debit and a credit column, just so that we can see this from this angle. I don't love pluses and minuses. I love thinking of things through a debit and a credit when we're dealing with journal entries. What's a debit? It's the left side of an account. It's the left column. What's a credit? It's the right column. What matters is if we know which accounts are increased and decreased by each of these. That mental framework, if we know that and memorize it. I submit to you that you need to memorize 5 things. We need to memorize 5 things. What increases an asset, liability, owner's equity account, and a revenue and expense account? If we know what increases each of these, we know then what decreases it. So if we memorize 5 things, what increases these accounts, then we actually know 10 things by default because we know what decreases it if we know what increases it. So here we go. Assets. These are increased by a debit and decreased. I'm going to highlight these. I'm going to highlight these in a light blue because there are balance sheet accounts. Liabilities are opposite. If you think of the accounting equation, assets equals liabilities, I'm mad if I can spell it, plus owner's equity. That equals sign, it's on the other side. So we've got to deal with that, and that's opposite here. We've got increased by a credit, and we have decreased by this side. I'm going to highlight. I'm actually going to write balance sheet account, and then I'm going to say I'm going to do an orange because that's increased the other way. I actually want to hop down. Stockholders' equity could be owner's equity as well. At this point, for introductory financial accounting, those are synonymous. This is on the same side as liabilities. We can deduct, if we use the accounting equation, the balance sheet equation, right? This is our balance sheet equation. That's a financial statement. We can match it up. It's the same thing. It behaves the same way as a liability. That is our balance sheet. Assets equals liabilities plus owner's equity or stockholders' equity. I mean, I could change this to owner's equity if we really wanted to. It's fine either way. I can just write, or stockholders' equity, whatever. They're the same. That's our balance sheet, and then we've covered 3 of our 5. If we know what increases, it's increased. An asset is increased by a debit. Liabilities and owner's equity are increased by a credit. We then can deduct what the decrease side is. Let me give you an example. If a business receives cash, they increase cash. So I need to know this frameworks. I immediately know I need to debit cash because an increase to an asset like cash, or an increase to equipment. Let's say we go buy equipment. That increase to equipment is an asset. It's handled on the debit side for the increase. I want to handle revenues and expenses because I said if you'll memorize 5 things, it will change your life in this accounting class, and I promise it will change your life, just like this recording is going to change your life forever. It's increases. I don't know how to say this. Increase, whatever, and a decrease on this side. Yeah, now I'm bugged. I want to do just. I don't want to make it a tense, so there you go. Present tense, I guess. It's increased by a credit. That behaves like an increase to owner's equity. Here's why. Because if you think of the income statement formula, the income statement formula is revenues less expenses equals net income. I've made that really hard to read, but revenues minus expenses equals net income. Well, how do we get to the next financial statement? The next financial statement is the statement of retained earnings. And that one is beginning balance of retained earnings, add net income less dividends equals the ending balance of retained earnings. So beginning balance of retained earnings, last month's ending balance is this month's beginning balance, plus net income for the current period, minus dividends for the current period equals ending balance of retained earnings. Well, what is retained earnings? Retained earnings is an owner's equity account. So where I'm going is that revenues and expenses revenues minus expenses equals net income. Algebraically, revenues and expenses are embedded here, right? If I were to make the long form, beginning balance of retained earnings, add revenues less expenses less dividends equals my ending balance of retained earnings. So I increase retained earnings, which is an owner's equity account, by revenues. I decrease it when I spend money on expenses like rent expense or utility expense or insurance expense. And I also decrease retained earnings when I issue dividends to owners. That's money going out of the business and back into the hands of the individuals who own the company. So algebraically, we have revenues and expenses that end up flowing into retained earnings. So income statement, revenue minus expenses equals net income. Here's our book formula or our traditional formula. I've opened it up a little bit to see the visibility of revenues and expenses hitting inside of retained earnings. So how do I look at that? I think of a credit increases owner's equity. So revenues increase it and expenses are the opposite, right? I'm actually going to do these kind of a different shade of the orange or tan, and then this one is an increase on the debit side and a decrease here. Why? Because expenses decrease retained earnings, which is an equity account. And that's shown here, or that's shown here in the expanded formula that I did there to detail out revenues and expenses. So I'm going to do a different shade of blue here, just to illustrate that this is income statement, balance sheet, BS, haha, whatever. Get your mind out of the gutter. So balance sheet, income statement. Now, everything else should now funnel off of these 5 main accounts. If you'll memorize the increase side of these, you then know what the decrease side is by default. And all of these other accounts that I have listed are sub-accounts of a main asset type. So let's jump into that. I'm going to start with assets. I'm going to chase down, do I have any other assets here? And I'll actually copy this just so I can, for the sake of time. I have cash, that's an asset. I have, let's see here, accounts receivable, that's an asset. I'm just pasting those in. Prepaid insurance, that's an asset. Notes payable is a liability. Okay, I'm going to go to liabilities. What are my liabilities? My liabilities, notes payable. The word payable is a good telltale sign for a liability. Unearned revenue is a liability. Whoops, something happened there with my copy. Unearned revenue is a liability. That means someone paid us revenue, paid us for sales that we haven't performed or completed. And we owe them until we complete or fulfill those services. And then notes payable, sorry. Notes payable. There again, we have the payable terminology rearing its head. A mistake I made in this example is I don't have accounts payable, which is a very common liability account, but that's okay. Life goes on. Okay, now owner's equity. We have common stock, retained earnings. Those are owner's equity accounts. We've just walked through the statement of retained earnings formula, how we solve for that number, and And that gives us, we've got one little item to take care of here. This dividends is over here. So if you had to look right here and say, does dividends act like a revenue or an expense? Dividends acts like an expense because in the statement of retained earnings expanded formula that I've done, where I've just broken out how this contains revenues and expenses, which is algebraically a product of revenue minus expenses equals net income. Dividends is actually a contra equity, or it reduces equity. So this is actually opposite. Dividends is increased by a debit and decreased on this side. So I'm going to kind of call this a contra equity. Maybe it's a contra equity. Decreases equity, but I'm gonna kind of color this yellow or green. Let's do green. Let me punch this home. Dividends is not an expense. Owners taking money out of the business, or taking retained earnings out of the business and giving it to themselves, that's not an expense. If owners pay themselves a salary because they hold a position in the company, that salaries or wage expense is an expense, but these are two different things. So for example, let's say I own an IT consulting company. I have one partner, we're 50-50 partners in the business. My salary and my business partner's salary, those are salaries expense. But when we take money out of the retained earnings of the business and share it and say, hey, we actually made a lot of money in the last 6 months and we'd like to take some more over and above our salary and affect the equity table of the business, the equity position of the business, that's a dividend. We're reducing the equity on the balance sheet by reducing retained earnings. And then let's come over. We have revenues and expenses. Man, I only did a couple of these. So if I had to find my revenue category, I'm going to copy this. What are my revenues? Hot dog bun revenues. That's funny. That's a bakery. And then I've got expenses. I have rent expense as an example here. So there you go. There's the rundown of what increases. One more time, it's worthy of comment. Do we know what decreases each of these accounts? Yes, we do. If we know what increases it, then we know what decreases it. It's like I have to memorize 5 things, but I actually, get credit for 10. You're welcome. That's mind framing right there. I'm making sure everyone's happy with their study. You do yourself a huge service in introductory or financial accounting 2010 or 201 or whatever it is by memorizing those 5 things. What increases our 5 main categories? What are our 5 main categories? Assets, liabilities, owner's equity or stockholders' equity, and revenue and expenses. All these other ones on my list here that I've challenged you to be able to notate are subcategories of those, right? Cash is an asset. Notes payable and accounts payable are a liability. Retained earnings and common stock are an owner's equity. Dividends is a contra equity. It is not an expense. And revenues and expenses are represented here. So there you go. Hopefully I didn't make any errors there. Yeah. And I hope this explanation helps a little bit. Okay. Let's go on to these journal entries. This is going to take a little bit of time here, but that's okay. What I'm going to do is I'm actually going to copy these over to our sheet 2. I've already started these. How do I want to do this? I'm going to paste those right there and do my best to make this as orderly as possible. Okay, let's take this first one. and I'm going to bring it up here, and I'm going to have to separate my T accounts here and try to make this as visible as possible. I'm going to actually take a quick break here and take a sip of Minute Maid Light Raspberry, and I'll be right back. Okay, we're back. I know you guys are excited that I'm back, and we are going to go after these journal entries. I did the first entry here. Rodney and his business partner each contribute $10,000 each to start the company and receive equal stock shares. For the infusion of $10,000 from two founders, 100 stock shares each. I actually that tips you off. There's 200 shares of stock now, and I ask you a question later, and that's actually in the other problem. Scratch this. Never mind. Forget it. I give up. So this right here was this first transaction that I did, and I completed that. I marked that J1 because I'm gonna use that nomenclature J1, J2, J3 as the journal entry as I quickly build T accounts, which represent the general ledger. These T accounts represent the general ledger. They're representative of it. A general ledger doesn't look just like this T account, but it's very similar, just maybe a little bit more formal. And you can see those in your textbook. You can go to what does the general ledger look like. This T account representation is good enough for my illustration. Okay. Now let's move on to the second transaction. So I'm gonna bring that up here. On January 2nd, I should try to make these bold so we make some. And on January 2nd, Johnson Company borrows $10,000 from Wells Fargo. So I'm gonna mark this as J2. And I'm gonna come in here. What the heck? All right, this is gonna take me off if I don't get this straightened out. Okay. I'm gonna come in here. Well, Johnson borrows $10,000 from the bank. That means the bank had to give him $10,000. Where Wells Fargo funds the cash on January 2nd. Funds the cash means hands it over to Johnson so they can use it, puts it in their account. So I immediately know the company increased cash. One more plug for my first problem. How do we increase cash with a debit? Why? Because assets are increased with a debit. Memorize 5 things, your life will change. That's $10,000, and then I have what is my credit? What's happened? Well, I now have a note payable to the bank. Notes payable. How do I know that? Because I borrowed money from a bank. That's how the word note payable is like a loan, right? This is a bank loan. It's the formal terminology for a bank loan. So there we go. I'm gonna come up here. I'm gonna whip out a quick new T account real fast over here. I'm not gonna put these in any specific order. So this is gonna be notes payable, and we've got J2, and I've got that here. And then cash, I'm gonna have J2, and I'm gonna have this here. I'm just referencing that cell so I don't have to type it over and over again. There we go. So after 2 transactions, this is a new company. The founders had to contribute money to start the company, and then somehow we convinced Wells Fargo to already give us a loan, which is probably unlikely unless you guys put your 1992 Geo Metro as collateral. There ain't nothing wrong with a Geo Metro, so don't be ashamed. I rolled one too. I actually rolled a Corsica, a Chevy Corsica. Look it up if you don't know what car that is. I don't care if I'm off topic right now because this is a sweet video. Okay. That's funny. Okay. Here we go. J3. So this is on January 3rd. I'm going to stop typing the date for the purposes of time. That's just because we need a date on every journal entry. This is going to be J3. And Johnson buys a $15,000 computer server from Best Buy and pays cash. I'm pretty sure Johnson Company was an IT company if I come back and look. Yeah, Johnson IT Services provides IT services to companies. So he's buying a server as a part of his IT services to provide IT services to other companies. So what did we have? We got equipment. I can write server, equipment server if I want to. What is this? This is an asset. How do I increase an asset? We already know we increase an asset with a debit, and we know that because we increased cash with a debit, which is also an asset. So $15,000, and we pay cash. So we reduce cash. This is the first time we're reducing cash. It's logical now that we're hopping over to the other side here. The credit. See how I pluses and minuses, plus this, plus that. I mean, I like it like this way, like this is, plus an asset, except for it doesn't let me do it in Excel. Plus an asset. This is, minus an asset, like a decrease to an asset, increase to an asset, decrease to an asset. But there we go. So I'm gonna make myself another quick T account down here. I'm gonna call it equipment, and kill those. So J3, $15,000, and we have our first credit for $15,000 from J3. Now, what's my cash balance after 3 transactions? My cash balance is 20 plus 10 minus 15. I have a $15,000 debit cash balance. The normal balance is the increase side, right? For equipment and assets, the increase side is the normal balance. What's the normal balance for a liability and equity? We have an owner's equity account here, and we have a liability now. The normal balance is a credit. That's its native balance. If we had a debit balance in notes payable, that means the bank would owe us, and it would actually be a notes receivable. But I wanted to point that out for normal balance because we have a owner's equity and a liability. Just as another quick reminder, assets equals liabilities plus owner's equity. Okay, let's keep on keeping on here. I've got journal entry 4. And what do I got here? Johnson receives $22,000 cash from a customer for IT services starting March 1st and ending December 31st for client Wiener Jazz. Go Utah Jazz. That's a plug for the Jazz. So I just increased cash. A customer, Johnson, receives cash. I immediately know I've already had 2 transactions where I increased cash. I need to debit cash by $22,000. And the question becomes, have we earned any of this revenue? This is a client contract. Have we earned any of this revenue? Unearned revenue. We have not. Why have we not? Because it's January 4th. I need to be clear on this question. December 2018. March 2018. March 1st, 2018. So we have yet to provide these services because we're in January, and this is a new customer, the Wiener Jazz. That's from Minions. It's funny. I think. I don't know. Anyways. So we haven't earned any of this revenue. So it's unearned revenue, which is a liability. We have increased an asset and increased a liability. I'm going to make myself a new liability over here on this side. I'm going to call it unearned revenue. And I'm going to go J4 plus 22,000. And then I'm going to go J4 cash. I increased 22,000. Okay. And then here we go. Let's keep going here. I need to pick up the pace. Less jokes, more awesome stuff here. Okay. January 5th, Johnson buys 5 toner cartridges on account for $500 each and establishes 30-day term account with Utah Toner Supply. So I'm going to put this as we're going to go J5, and I'm going to go debit supplies asset for 5 times 500, and I'm going to credit. This is important. Accounts payable. Why am I going to credit accounts payable? The question is, how did I pay for this? Buys here is pretty much implying, even though it's not explicitly stated, that we assume I have the toner cartridges. I went and picked them up and I bought them and I paid them and I established an account so that I could pay later. So I owe Utah Toner Supply until I make that payment, and they've given me 30-day terms account. That means I have 30 days to pay for my purchases. Accounts payable. Wow, spelt that really well. Accounts payable is the payable tips us off, right? What type of an account is accounts payable? It's a liability account. What increases a liability? A credit. So 2,500 bucks, and now I need to ratchet this thing back here from for IT. Yeah, I think I can cash for IT services starting. Yeah, that'll work. So I got to make a supplies account here. J5. Okay, so I have toner supplies here in the supplies account, and I have accounts payable. This is an asset account. I'm gonna move these to supplies expense when I use them, and that's for down the road. But there we go. Okay, what I'm gonna do is I'm gonna copy all this and I'm gonna move it down so it can hang out with us here as we continue on. Hopefully this is the nice part about the video, is you can rewind if you want to see something previous. Let's see. Insert down. Oh, it's awesome. J6. Okay. Oh, whoa. I gotta fix this. We're gonna, yep. Okay. Johnson receives $10,000 cash for January 2018 IT services that have been completed for customer Lady Jaja. Also funny. 10,000 cash. Hey, this is the word I want to focus on here. Completed. IT services that have been completed. The question is, have we earned this revenue? Up here, we hadn't earned it because we got paid for a contract that's in the future. Here, it is very clear that we have earned this money. We've completed the services. So we received cash. Looks familiar. We've had a debit to cash on a bunch of these. You should be getting familiar when we increase cash. It's a debit. Credit, and if we decreased cash, it would be a credit by default. A credit. And then we're going to have revenue. So I'm going to go IT revenue. Revenue would work as well. In this instance here, it's fine. Just more specific naming convention. And I'm going to, because I showed you how revenues and expenses turn into, embed into retained earnings, I'll stick it over on this side as well. This is our first income statement account. It's the first account where we've had revenue or expenses. So, and then cash, we've got J6. And I'm going to cash that out. Okay, if I were to stop right now, I've got 3 more transactions. If I were to stop right now, what would be our balance in cash? We'd add these up, 62,000 minus 15,000. So what is that? $47,000 debit. The normal balance is what increases the account for these permanent accounts of assets, liabilities, and owner's equity. Okay. All right. Let's do this. What did I just do? Okay. All right. Let's hustle through these. Come on. Okay. Journal entry 6. January 24th, Johnson pays $15,000 cash to their landlord for rental fees for the months of February, March, and April. This right here, this is J7. We're prepaying rent. So this is not an expense for January. We must have paid that prior, like in December. But I'm going to go ahead and go prepaid rent. This is an asset. Prepaid rent, prepaid insurance, these are assets. And of course, we had a decrease to cash. So debit, prepaid rent, credit, cash. Why? Because cash went out the door. So we've got $15,000 in prepaid rent in this. So I'm gonna, or let's see, sorry. J7. Okay, now I'm gonna make myself a new asset account. Prepaid rent's an asset the landlord owes us until we use that rent. That's why it's an asset. Prepaid rent. I'm paying him before he's fulfilled the services of allowing me to use the building for a month. On his side, it's unearned rent revenue, which we've had an example of unearned revenue in our examples. I don't want to make this too complicated, but on the landlord side, this is unearned rent revenue. He has not yet earned it because the time has not yet passed in the rental period. So prepaid rent is an asset. We've got $15,000 for J7. Okay, what's our normal balances? We could calculate. The only thing that has debits and credits right now is cash. Again, I could tally that up again, and I'd have a debit balance, normal balances, or a debit here, normal balances, or credits here. That fits within this framework. What's the normal balance of an account? The side that increases it is the normal balance of an account. Okay, let's wrap up. Debit. What do we have? Johnson pays $3,000 cash to their insurance company for February 1st, 2018 to July 31st insurance policy. We've got prepaid insurance this time. Why? Because we've paid the insurance company before we've used the policy. And then cash. Really wish I would have had a straightforward rent expense or something. Or let me do I'll add one transaction really quick. So I'm going to create another account here. This is another prepaid account. That's okay. Give us a little space here. Prepaid insurance. J8, I believe. Yeah. Got to be uniform. Okay, so I've got J8. Okay, and then I've got to do J8 here. Don't let me forget. Hope you caught that. J8. What's my balance in cash? 20, 30, 52, 62 minus 33. We'd have a debit balance of 62 minus 33. What is that? 29? I'll let you figure that out after 8 transactions. Okay, let's finish up, and then I'll add one journal entry to make sure we get an expense in this example, an expense account. January 30th, Johnson bills a customer for $18,000 of work performed in January. Terms are 15 days from the invoice. That means that this screams we billed the customer. That does not mean the customer paid us. That is why this doesn't involve cash. Has cash changed hands yet? No. The customer does owe us because we've billed what we've completed for the month, performed for the month. So accounts receivable of $18,000, and we're going to credit service, or excuse me, IT revenue, because we have completed, performed it. That performed is a key word. Bills is a key word. The fact that it has terms means that we didn't transact cash. The customer has 15 days to pay us from the time we billed this invoice. So this will be due, February 14th. So I'm going to come over to the revenue account. I've increased revenue again, J9, and then I'm going to come over to, I actually need to make a new account. I need to make another asset account. Accounts receivable is an asset account. The customer owes us, so it's an asset to us. Accounts receivable, we call this AR. Accounts payable, we call AP. So going forward, you'll be able to see AR, AP, J9, and I've got $18,000. Okay, let's add a bonus item here because I know you want me to. Johnson pays its utility bill in the amount of $500. They pay cash. They go down to the utility booth and pay it. Let's just roll with it here. We have let me be clear. This pertains to January 2018 garbage and recycling. We got a big recycling bin because we love the earth. We should love the earth. If you don't love the earth, you should be nicer to it. What does that have to do with accounting? Don't worry about it. Utilities expense, credit, cash. Why? Because we paid the utility bill for $500. Pertains to January. $500, $500. Well, I'm gonna make myself a expense account. I'm gonna put it over here because it's increased by a debit. I want to have all these increased by a debit on this side. I have a bunch of increase, by credit over here. See how revenue and expenses, these are income statement accounts, right? And then of course I need to deduct cash of $500. And I'm pretty sure I've balanced this out. Oh, whoops. I just need to do plus $500 here because it's on the credit side. So this is J10. I'm gonna pretend real quick. I'm gonna act like we're done with the month completely real quick to wrap up this video. I'm gonna say plus this plus this plus this plus this minus this minus this minus this minus this. That's basically all the debits minus the credits. I have a $28,500 balance at ending balance. I mean, I'm not going to do this on all of them, but there's my ending balance for January, right? If I made this even better, I would say, ending balance 130,118. I won't do that on all of them, but what I do want to do is I want to add up. I'm going to add up all the debits. I'm going to say, here's all my debits, and then here's all my credits. I want to do a check figure on this. Let's see if we balance after I reconciled cash. Whoa, look at that. We got 82,500 and 82,500. Do you like how I just did that check figure? Do our debits and credits need to balance on every transaction? Yes. When we're done, do the balances at the end of the month, do the debits equal credits? Yes. To the penny, it should be. We sometimes have some errors that are really hard to find. Excuse me. I'm putting myself to sleep. Oh, sorry. I'm sure you're exhausted too. That wraps us up for the second question here. Let's record the journal entry and let's put them in the T accounts, which I'm calling a solid representation of the general ledger. I moved that down. Here's all of our transactions. I added a transaction in there because I wanted to get an expense account. It is late. I'm getting tired here. I wanted to add an expense account to this example. I am going to create a second video for this one. So this is what have we covered? We've covered the debit and credit framework, what increases, decreases our account types. 5 main account types is our focus. And we've gone through journal entries and created T accounts to be representations of the general ledger. There you go. We'll be back video 2 for our third piece, which is creating financial statements out of a listing of accounts. It's actually not a trial balance because it's not in order. I have a check figure there for you. And we'll create an income statement, statement of retained earnings, and a balance sheet for Rod Dog Bakery. Over and out, friends.